Good afternoon. So I'm here, Tufano. Welcome to this final session of the day before we go to dinner. And congratulations, you found Harvard Law School. And you've also made it through what I think is a full and lively, and for me at least, a stimulating day. So I hope you've all found it to be the case. So I don't want to recap the whole day, but if you were here in the morning, Andrew Forrest said, this is a failure of leadership. And then if you listen to Senator Markey and Senator Whitehouse, this is really a failure of the political system, and it's a failure of the ability to find a compromise. And if you were in the session over there, you said it's a failure, but this is an opportunity of science. But if you were in the first session, you also had Aditi Mittal, who said, well, it's really about costs and willingness to pay. And so at the end of the day, it's often about money. So and this is the end of the day. So it is going to be about money. And so what we're going to spend the next hour talking about is, in fact, how are we going to finance all this great stuff that has happened? We have a great panel that I'm going to introduce in a moment. I recognize some of you are ringers. You are experts in climate finance. But how many of you don't feel you have a full grounding in climate finance? Great. So for all of you, I'm going to spend about 5 minutes to just get you oriented, level set. And then we'll get set up into the discussion. So I'm going to give you a few numbers. I see a former student here. You can attest that I like numbers. So if you just wonder, like, what are we talking about? And first of all, shout out, anybody here from Climate Policy Institute? If you are, big thank you. Most of us in the field use your data on the size of the climate finance industry. So how big is it? Right now it's about $1.27 trillion that we're spending. This is their 23 report, which I think represents 22 data. So we're spending about $1.2 trillion. Go to climate science, you don't have to take a picture, you could read the whole thing. So that's what we're spending. And the way to read the chart is the bottom is private sector, the orange is private sector, the blue is government sector. There's a little tiny bit right here that's adaptation, and all of this is mitigation. So we're spending most of our money on mitigation, little tiny slice on adaptation, and you can see where it's coming from. So is that a lot or a little? Simple question in a business school classroom. I won't ask you whether that's a whole lot or a little. I'll give you some benchmarks. So how much, well, relative to what? Well, relative to how much we need to spend on climate finance. So again, CPI has been great. They've provided a range of estimates because there are lots of numbers here. Numbers from McKinsey, numbers from EIA, numbers from BlackRock, numbers from everybody has different numbers. And I don't know exactly how they've done it, but they've said, we need a lot relative to existing spending. So what you're seeing there is, spending on climate finance, which really has quadrupled in the last decade, from $360 billion to $1.2 billion. But what we need is that thing up above, which is a lot bigger. And there's an error band around that. So we need a lot more. And you might find that depressing. Another way we might think about it is it's a lot relative to GDP. So I don't know if our friends from McKinsey are in the room. I know they were on the panel last year. They were fantastic. But these are some numbers from McKinsey. In order to decarbonize, they are estimating we need to spend, on average, 7.5% of global GDP each year between now and the end of 2050. Front-loaded. Again, you can go to the McKinsey website and you can pull this down. All right, so that seems like a lot, 7.5% of global GDP, or it seems like a lot in that's a big bump from where we are to where we have to go. Well, there's a different answer that says it's a lot, but it's a considerable amount, but we know how to spend this amount of money. So this is how much we're spending on climate finance, 1.3 trillion. Well, we need maybe, again, these are the numbers from Climate Policy Institute, maybe we need 8.6. Generally, that's considered a gross number, not a net number. It's probably less than that. But we spent, 2.2 in global public expenditures and military. Fossil fuel subsidies, they're getting $7 trillion, so maybe we could repurpose some of that. And then we spent 11 trillion on COVID, so it's a lot of money, but we spent a lot of money on other things, and maybe we could spend it on this. But there's another answer that says it's actually a little relative to the benefits. So I'm going to now cite a paper of one of my co-teachers in a doctoral course that I teach across 130 schools. This is Patrick Bolton. So here's the present value of the cost of phasing out coal. So they've done a fairly exhaustive study of what it's going to cost to get rid of all coal. $29 trillion. It's a lot of money. They've also done an exhaustive study to figure out what the benefits are. And the benefits are at $80 a ton for social cost of capital, social cost of carbon, $114 trillion. And using the current US government estimate for social cost of carbon, it's $270 trillion. So yeah, it's a lot of money. $29 trillion is a lot to get rid of the coal industry. But the ROI on that is huge. Or another set of numbers. This one's going back to Climate Policy Initiative. They're saying, okay, it's going to cost us $266 trillion in order to address climate issues between now and 2050. So that's kind of like the numbers you saw before, $8.5 trillion over 50 years roughly. But the benefits are huge. So if we look in here, we're going to save 1,266 trillion. There's a number that is bigger than a trillion. I just don't know what it is. You get the sense. So the ROI there is going to be like 4x, 5x. So that's pretty good. So it's a lot of money, but we know how to spend that much money. And it's really quite small relative to the benefits. So what's the problem that this illustrious panel is going to have to deal with? Well, reconciling the lot limit. This is the Goldilocks problem. Is it too hot? Is it too cold? Well, it's a little bit of both. So what we have to do is we have to get more private and public money, and we have to use that to generate this huge set of returns, much of which are social benefits, and some of which are private benefits. So if you think about all that, we have to think about whole systems benefits, which is why the curious title of this is Whole System Finance. And how might you do that? So we have a research project here at Harvard that's trying to figure this out. As with most things, there's either a 2x2 matrix or an alliterative set of words that you can remember. I have neither of those. But we have to do climate risk engineering. We're going to have to fundamentally re-engineer a bunch of risks, financial risks. My background is as a financial engineer, but also operational risks, political risks, foreign exchange risk. We're going to have to do some what's called blended finance, get lots of different parties. And you're starting to see what this is all about. And a person from BlackRock, a financial firm from ArcelorMittal, an industrial firm, and from the IFC. So that's the blend. And then we're going to have to transform returns in a way that we make them available so that both private and public parties want to do their work. So with that, since I've just kind of laid out the teaching question, they get to do the work. And who's they? This is a remarkable panel. Somebody told me after the fact, Peter, you have a panel of all women. And to be honest, I never thought about that because these are great people, and literally it was a shocker after the fact. But we do. It's wonderful. So we have Anmay Dittman from BlackRock, and we have Irina Gorbounova. Is that about right? Thank you. Head of XCarb for ArcelorMittal. You heard her boss this morning. And then Lana Graff, who's the venture capital global lead for AI and deep tech at IFC. That's all the intros I'm going to do. I'm going to ask them each to spend about 4 or 5 minutes to explain what they and their organizations do, so you have a kind of a rounded sense, which is not on their bios, about what BlackRock's doing, what the IFC is doing, and what ArcelorMittal is doing. And then from there, I'll have a bunch of questions, and in about 25 minutes, then you get to ask questions. So start making your lists. So who would like to start? Anmay, you want to start about what BlackRock's doing?
Sure. That was a very easy problem set, so, Hi, everybody. I'm Anmay Dittman. I'm the managing director at BlackRock, and maybe more critically for this discussion, I head up our climate finance partnership. So what's that? CFP, as we refer to it at BlackRock, is our flagship blended finance fund platform. We invest in climate infrastructure in emerging markets, and those markets for CFP are Africa, LATAM, and Southeast Asia. So really spicy work, I would say, but not as spicy as the work that you were mentioning to me when we spoke. I am a lawyer by background, so this environment is perfect for me. It came in very handy because I joined BlackRock around 6.5 years ago. I was originally working on the platform for inorganic opportunities to grow our infrastructure platform at the time. And I did not know that this would fall into my lap. It was really by happenstance. And this is going to come in very relevant to the engineering point when I conclude. Climate Finance Partnership began really with a conversation between our CEO, Larry Fink, and President Macron. It was at a summit called the One Planet Summit at the end of 2018. And that's where it was conceived. And the problem set at that time was, how do we mobilize private capital into these markets that need it the most, that are the most vulnerable to climate change, but yet we don't really see private investors going in because of the real or perceived risks in these markets. So, problem set comes down to our desk, and we get working on developing the vehicle. We brought along, Germany came along, Japan came along as well, together with some US impact organizations, as well as a strategic investor, to provide that catalytic capital into the structure. And then we mobilized private capital into the structure at a rate of 1 to 4. So every dollar of public capital, we raised $4 of private capital. We raised it faster than any other product we've done on our platform, which really showed us that it really resonated with private investors, which is super important, obviously, at BlackRock. What we see ourselves as being able to do is we're really that connector. So we have a public clients who come to us saying, we have a mission that we're looking to solve, and they bring along BlackRock to be the one who understands the private investors to bring those two together. So it's a lot of what was shared up there. But I'm going back to the engineering point because I'm so pleased to see how many people are in this room. I really was shocked. I came in like, I can't believe so many of you are interested in blended finance because honestly, sometimes I think about how difficult it is to do this. And no one in their right mind will wake up in the morning and say, this is what I want to do. But we do need more engineers. We need more people who are interested in this, who want to do this. Because if we really want to scale blended finance, we really want to solve those gaps, those problems, we need more engineers. So thank you for your time and really looking forward to this conversation today.
Great, thank you.
Is it on? Can you hear me?
I think
Yes.
Hi everyone, and it's a pleasure to be here, and thank you, Lisa, for inviting us. Indeed, I agree with you. I'm, quite impressed how many of you are here. And maybe one question: how many of you were at the first session that Peter was referring to with Aditya? And so you're all now experts in steelmaking. I guess I'm not going to go into steelmaking as such because you all now appreciate what the challenge is. But maybe since we are talking a lot about numbers, one question: how much steel is produced globally? Do you know how much steel is produced globally?
Take a guess.
Take a guess.
He only said primary versus recycled, 70% and 30%.
And in absolute numbers, like someone can guess, right?
100 million tons?
100 million tons. Anyone else? Any other guesses?
100 million and one.
That's crazy, right?
More.
1.9 billion tons?
So close to 2 billion tons of steel is produced globally. Thank you very much. And this number is set to grow to anywhere between 2.5 and 2.3, 2.5 by 2050. And then one more question, and I think those of you who were in the first session will be able to answer that. How much CO2 is emitted per ton of steel produced?
2.
Good. And now you can do the math. So you know how much CO2 is emitted by the steel industry. You can do 2 by 2, so it's 4 million tons. You also know the number of total CO2 emissions globally? Anyone? 50. So that's just to set the scene. So close to 50 million tons of CO2 is emitted globally. Out of them, it's 4 million tons, which still is contributing to the atmosphere. So you can do the math. Still alone accounts for just below 10% of global CO2 emissions. And that's the reason when we talk about financing, I think I'd like to set the scene so that people can appreciate how much steel contributes. And contribution is, of course, has a negative connotation here, but how much we are accountable in terms of the CO2 emissions. But the good news are there are technologies to produce steel in a way that we can reduce this, and we can produce steel in a low carbon manner. And steel is another piece of good news. It's actually a very versatile material. It's infinitely recyclable. You need it for everything pretty much related to energy transition. If we talk about solar panels, wind towers, electrical vehicles, low carbon infrastructure, data centers, nuclear plants, just name it, you require steel everywhere. So hence we have a challenge how we can produce this versatile material in the most responsible and sustainable way. And our group has pledged to become carbon neutral by 2050. Again, very challenging, but nevertheless we are determined, and we have a number of pathways that our CEO was talking about earlier. But just to summarize, we are looking at 3 ways to produce primary steel in the most low carbon way. One is what we call innovative DRI. DRI stands for directly reduced iron, and the innovative part comes because of hydrogen. There are already operations where we have directly reduced iron based on natural gas, and the idea is to start blending hydrogen into the mix to eventually phase out natural gas and have this produced on hydrogen. The challenge there is that although some of our facilities are hydrogen ready, it's really the availability of the hydrogen infrastructure. I think I was looking at the EIA report last year. I'm not going to start asking questions because I could also ask you how much green hydrogen do you think was produced globally last year? Maybe I did. How much do you think was produced globally? Any numbers? Okay, I'll tell you the numbers. So it's 100,000 tons, even according to International Energy Agency, was produced last year. And to give you the perspective, if we were to use all of this produced hydrogen last year, we could produce 1.5 ton of steel. So that gives you the drop of the ocean it is, in terms of availability of hydrogen now. That's the reason the second pathway that we are looking at is what we call smart carbon. It's basically using existing facilities, using blast furnace operations, but trying to replace or reduce the usage of fossil coal by replacing it with biocoal, with biochar, and leveraging CCUS. There was a lot of discussion on CCUS, and our CEO was talking a lot about the importance of capturing carbon, because this is something we can do now. We shouldn't be waiting until hydrogen infrastructure becomes available, until other technologies mature. We need to do things now and reduce it to the extent we can. And that's the reason, as an example, we have a pilot plant in Belgium where we take wood waste, biomass, and through liquefaction we produce biocoal, which we then feed into the blast furnace instead of fossil coal. So we replace it with the biocoal, and then we capture the off gases from the blast furnace, and using the biofermentation technology of one of our portfolio companies called Lanzatec, we produce bioethanol, which can then be used as a transportation fuel, as an aviation fuel. And cases like that, I'm an extreme fan of circularity. So if you can start with waste and produce something which is useful and reduce emissions along the way, and I think this is something, of course, that we should try to pursue to the extent we can. The third way to produce steel in a low carbon way is again something that has been discussed a lot today, is direct electrolysis. This is a great technology because the principle there is that you don't need to use hydrogen or coal to convert iron ore into iron, but you can electrify. And there are a number of startups in this space. A lot has been said today about Boston Metal. I went to see the facility yesterday. It's really impressive what they're doing. And you have the cell where you tap iron ore and you electrify it. It's molten oxide electrolysis at high temperatures. The temperature is around 1600 degrees. It's pretty high. It's still, of course, in the lab. but the company is aiming to get to a semi-industrial demo by the end of the year. Lana is also an investor in Boston Metal, so it's one of the great examples where you get very pertinent to the blended finance conversation, how we can get those startups to scale up. But in addition to all of those pathways that we are developing, we decided to launch XCarb Innovation Fund. So that's what I lead. It's really to supplement our broad efforts by setting a platform to identify some of the most brightest and promising technologies to support our net zero efforts and really to accelerate our journey to get to this carbon neutrality.
So we have, both you as an investor and you as a capital raiser, right? Because presumably you need to raise a lot of money to do all the things you need to do.
Correct.
Lana, from the IFC's perspective, maybe a word or two about IFC and climate in general, and then specifically how did you and Irina kind of connect on this?
Of course. Hi everyone. So on IFC, so we are private sector investment arm under the World Bank Group umbrella. So World Bank consists of World Bank, subsidizing and financing governments. IFC private sector, we have media, insurance and protection, and IBRD. So under IFC mandate, obviously there is a huge interest for financial contributions and work in emerging markets. So this is where we quite overlap with BlackRock. In fact, our mandate is like purely emerging markets. We can start with the technology or the company origination, let's say in the US or in Europe, but offtake, all the production, everything should be happening or has potential to happen in emerging markets. And the case that Peter brought us all to talk today about Boston Metal, that was also around our logo or like motto. We have it as a creating market and creating opportunities. So innovation, like let's say decarbonization of steel or cement, a lot of those things happening in emerging markets, mostly 90%, let's say, at least in our books. And when we're thinking, okay, let's have iron ore and send it immediately to some locations where it will be processed with any type of technology, it decreases the value for the local community, for the market, for certain countries. There is a lot of iron ore production, let's say, in Mozambique, and it would be just, I would say, sold, not at the most beneficial pricing. It's not like price parity that would benefit to the society. And then you have innovative solutions that are modular, where you also have something to say in terms of IP, how we call it technology transfer. This is where the work of World Bank is actually visible, because we're bringing some innovative solutions into multiple countries across the globe. And around that, you have job creation, obviously a lot of EMS facilities being set up there. And it's quite fascinating to see that at first the value of iron ore extraction would be X. And then when you bring innovation where you're building the entire city around, like new type of facilities, doesn't matter, is it steel, like water purification or like glass production, anything related to green build, the entire city is actually building up. And that's quite fascinating. It's a significant impact. In terms of our pledge to climate and sustainability, obviously it was announced again at COP28, like as everyone, we're trying to support this movement. In our case, it's not only equity investment. The biggest power happening from project financing, of course. And when we see players like Arcelor interested in some technologies, this is a huge signal for us. This is where we're also kind of almost sure that it would be an offtake from some innovative solutions. So this is even de-risking or attempt to have a blended finance across the partners.
So roughly what's the size of the commitment by the AFC on climate?
So at this point it's around 8 billion.
Okay, and how much total climate funds are kind of not just in your facility but across BlackRock, what would you say?
So our pure play climate infra funds, because obviously some of our diversified funds also do climate investing, but pure play 11 billion.
Okay. And I assume.
Well, we do have a number of things, because so we said to reach our 2030 objectives, we're going to invest close to 10 billion. But it's both venture side and, for instance, another thing I do is I'll look at M&A activities around decarbonization assets. For instance, I made 4 acquisitions of recycling assets in the last 2 years, which was more than $1 billion. So it's a little bit of both. So it's venture fund, which is now close to 300 million of committed allocated funding. We launched 3 years ago with the intention to invest roughly 100 million each year. And then on top of that, of course, you have projects. We also developed our own renewable energy. We have around 2 gigawatts of energy that we invested globally.
So in terms of putting money out and getting into, we're talking about 30-ish billion gross. Anmay, you've been running, and there's others in the audience that have numbers like that. You've been running the climate partnership for a while. What are some initial lessons? What didn't work? What did work? Because you've got this unusual partnership of private investors and development banks. So that's the blend. Sometimes some blends work better than other blends. So what is it that you've learned?
How much time do you have? A lot. I mean, obviously, I can't possibly do it in a short time, but I think maybe the key lesson is you really need to earn the trust of all the investors in your capital stack. Because at the end of the day, if you want the blending to work, then you really need to understand exactly what each mission set is for the investors, because even in like a catalytic grouping, or the more public side investors, let's say, they even in that class of investors have differing goals and mission sets. So if you're going to set this balance just right amongst these different set of investors and to really resonate in the private markets, you really need to understand what they're looking for, and then you need to earn the trust that you're managing their capital in a way that is risk aware, and that is delivering on their goals. So it's a lot of work because you really need to do a lot of listening. You need to do a lot of learning. We actually, it's interesting you mentioned the DFIs, because a lot of people said to me when we did the climate finance partnership, oh my God, you're working with the DFIs, they're so difficult and they have so many, Honestly, they upped our game. I have to say the partnership with them has been amazing. They've operated in these markets longer than BlackRock has in these emerging markets. And, frankly, I think that, I think they learned from us, but we also learned quite a bit from them. Notwithstanding that there were long hours, it was a very fruitful partnership.
Well, how about from the IFC's perspective? They've been doing this for a long time. You've been doing this for 5 or more years. So what are the learnings so far in terms of this thing called climate finance, whatever it is it a thing? But what are we learning that's working well and less well?
So I don't know if I would do good for IFC brand or not, but we also have to change. We've been in those markets for so long, and obviously how things were done, let's say 10, 15, 20 years ago. It's not the way how you do it now. And in terms of risk assessment, it's not just ENS or social governance or at this point, gender awareness or something like that. It is actually who it is with you at the top table, what you're going to do if the company is running out of cash, and who will be there alongside with you. And at this point, it's not only investors, it's a lot on government, their program. It's also, you guys won't believe, but we are also relying a lot on academia because they need to provide with a lot of very, very smart people who are also learning alongside when we're deploying certain solutions. And then there is a whole new type of things happening, of course, across blended finance. We started to look at it as almost layer by layer by layer that you have to convince the government there should be some academia involvement and grants. And then, okay, what industry is thinking? And then you're looking at some early stage investors. Okay, then CVC coming in. What about, again, those early stage investors? Do they have any, dry powder there? How is our cap table looking? So there is so much to that I see simply not sometimes was equipped, to look at, when we are coming in, we need that and that, and this is our terms. And then when sometimes there is a noise like, oh sorry, but we are kind of not interested in such terms because there is other investors, like how they're operating. This is the cold shower, but at the same time, it's so important because now it's a global commitment. It's a global pressure, to deliver those climate solutions. Now we have to work all together. So it's been fascinating to see the transformation. I applaud, our leadership open to that. We're learning quite a lot from private sector, from global investors. And it is so good to see that global investors right now would like to be mobilized, by FC, that there is still a trust name, we will do our job, obviously, in the locality, we will work with local currency, all this protection and everything. So there is a whole new type of partnership based on the approach.
Maybe I can just take the two. You're saying you're learning from DFIs, you're saying you're learning from public sector, so what is it that you're both learning from each other that you wouldn't have known otherwise?
Oh, it's just flexibility from our side, kind of just to hear what other investors are looking for.
Well, one concrete thing for us on CFP is that we had this pure play platform, $11 billion, but we had never invested in emerging markets until we did CFP. Or I should say, not never, only a fund dedicated to just investing in emerging markets. And what the DFIs have always used from an E&S perspective is something called ISC performance standards. That's a very standard, it's an international benchmark for E&S risk management in emerging markets. That was not something that we had applied because, of course, our funds previously had invested in OECD markets. And now, so what we learned, because we applied IFC performance standards for CFP, for the fund and our investee companies, was a whole new set of methodologies, processes, procedures, and roles that were expected in this community if you're investing in emerging markets. And I would say we learned quite a bit because it actually enhanced the process. I mean, of course, we had existing processes, but those are processes that were fit for OECD markets. And so what we learned, one tangible thing, there are many, many lessons, but one of the things that we learned was this sort of emerging markets standards and how you would engage, let's say, stakeholders, for instance, in communities. That's a very, very specific thing in emerging markets is stakeholder management in communities because you're not dealing with, obviously like the regular way OECD stakeholders where you know who the stakeholders are. Sometimes in emerging markets you might not know, or biodiversity, I mean, it goes on. But no, we there are a lot of things, but that was a very tangible thing that I would say that really enhanced our process.
The notion of blended finance is that different parties are going to take different parts, either capital stack or different instruments. Different parties may have different risk preferences. So as you look across the blended finance deals that you've done and you've seen, who seems to be unwilling to hold certain kinds of risks? So is there some risk sorting that's going on in the blend? And is it systematic in a way that we can learn from it?
Yeah, I can. That's actually a very good question. I think now the finance is so different from clean tech 1.0 because it really goes beyond venture, right? And if you look at all the funds raised in the last couple of years, there's a lot what I've seen. There's a lot of funds focused on very early stages, and a lot of funds focused on the very late stages. And I think the reason for that is that those with high risk appetite, they just don't have the ticket size of the funds to really fund some of the some of the companies which go into the stage of being deployed, and those with the deep pockets that don't have the risk tolerance to fund some of those almost mature but not fully mature technologies. So there is this gap in the middle. I think this is the most difficult one to fund. We really need to have this, to build this bridge to bankability. And it's not going to be built overnight, but we really need, Peter, you called it a sophisticated capital stack, right? We need to really come up with some of those layers and bring some of the different parties to the table to make this, I call it, I think Clara was referring to as layers, I call it like a capital stack cake. You need to really layer it up to get to this first of a kind, the really industrial scale. From our perspective, every investment we make is not just kind of a passive investment, so that we invest and see if it's going to work out. It's always a strategic lens. We are looking to decarbonize the steelmaking value chain, regardless of the technology pathway we take. And I was talking about this technology pathways earlier. Steel industry is very energy intensive, so we need a lot of clean energy, a lot of clean electricity. So for that reason, for instance, we invested in nuclear power. One of our companies is TerraPower, which, by the way, are breaking ground today on their first facility. So that's something that, and we would like to see if we can work with them to power some of our facilities in the future. And then, of course, we are talking about renewable energy. Long duration energy storage has to be the name of the game, because again, we need the energy 24/7. It's really the base load that we require. That's the reason we invested in a company called Foam Energy, which is a multi-day, 100 hours plus storage. But in addition to that, we also signed a joint development agreement with them to work on tailoring the battery to meet the specification, and because it's based on iron ore, so we actually delivered some of the iron ore from our DRI, from our operations in Mexico for their testing and for their lab work to test the battery. So I guess what I'm trying to say is it's not just pure financing, it's really this package of the equity investment coupled with the strategic agreement that hopefully will get them to bridge some of this gap. It's still, there are still challenges. I can see we can get to stage C, and quite often in some of the examples I see that, the companies need this additional 400 million or so to get to revenue. So they can't really go to the IPO or any other exits. It's really this funding required, which is required. The traditional lenders, well, they turned around to solar and wind, they're still not going for some of those mature technologies. So we see some of these mega shops like Blackstone and Brookfield and Temasek, raising the funds. So I see movements in the space, but it's still insufficient to really fully bridge this gap.
So as a strategic investor, you look at these risks slightly different perhaps than a financial investor or as a government or multi-government. So in the private sector, do you see clusters of different kinds of investors? Like, I don't want political risk, I don't want FX risk, I don't want this, I don't want that. So what's the kind of the menu that you're seeing of investors and their taste preferences?
Yeah, that's what I meant by, understanding everyone's mission set and their risk profile in order to do the blending, right? Because if you actually have a blended fund at scale, there are going to be, I don't want to say compromise because that's probably too strong, but people are going to have to accept maybe some things that are pushing them, but then they'll also get other benefits. So, if you think about the traditional institutional investors that are out there, you have a lot of pension funds and insurance investors who are pretty steady. They're not exactly wanting to take a lot of risk, right? Like that they have a constituency where they want steady cash flows. I mean, the typical infrastructure investor, a steady cash flow is not they're not trying to hit for the fences, but they want it to be steady. And then you'll have other investors, who are willing to take on more risk, maybe have a greater appetite for things like FX and political risk, for instance. But and then you have, of course, the DFIs who are completely different. They have a completely different mandate than the institutional investors. So to set that blending right, you kind of need to know your top and your bottom. The top range and the bottom range of every risk category. We for the Climate Finance Partnership, I think we developed a pretty elegant and flexible way to deal with that. But that took, 2 years. Come on, it's nothing. It was during COVID. It took a long time, and so what my hope is that it can take a lot shorter. That we start understanding, like you said, having those buckets more standardized in a way, so that we can kind of fit the pieces together more quickly.
Flexible and elegant, say more.
We developed our blending at a fund level so that it's completely, it covers sort of all the risks in a bucket. But of course now you have to set the economic parameters properly, the commercial details to be, so that's the trick. But we set our fund profile so that it's an entire fund protection. So it covers all risk, whether it's political risk, whether it's FX. I mean, of course, the team on a deal-by-deal basis would be addressing FX risk, political risk. I mean, to the extent that we need to take out PRI, to the extent that we need to do hedges. Of course, you're doing that on a project-by-project basis, but we also set this sort of overlay at the fund level, which is why it's simple and flexible. But to get it there, the guardrails, all the parameters had to be set over a lot of time in working with each of the individual investors.
And Lana, the IFC, what kind of interesting deals have you seen that have really tailored this climate financing to the appetites and capabilities of the investors?
So for us, we not really into taking too much risk for pre-revenue companies. So you can imagine that all of this innovation, or how we call it deep tech, we're only starting. But really, I hope we will do more. We at this point developing quite a lot of famous name funds programs where we would like to look into the offtake agreements, etc. At this point, what's the most important, and I already mentioned that, to see who is at the cap table, like people like Irina, other investors like BlackRock, other DFIs, because that would be almost mutual mandate and the risk appetite, so it means that we would be quite comfortable there, but at the same time, it's just like, what are we kind of bidding against, like if we are providing project finance for us, like every equity investment, we call it almost upstream, right? Mainstream would be way, way bigger tickets when we're helping to build out those facilities, that would be project financing. And that can go on and on and on. We're trying to understand if the markets might be repeatable, and that's fascinating, like when you can develop one solution for some country and then repeat it. Fantastic. And what would be the downside protection? So imagine to find the innovative solutions that are only, like being born very, very recently, and then figure out what would be the downside for us so that we can lend comfortably in our style money. So this is the challenge at this point.
And you and Irina both mentioned the term offtake. Probably 90% of people, but for the other 10, what's the importance of offtakes in these deals? Any of you?
I think the first.
What are they first? What's the importance of them?
I'll give an example. There was I went to a lot of hydrogen summits and hydrogen conferences, and at some point people were looking around and they realized it's all hydrogen producers, and there's like all the supply side, and it's like no one on demand. So then people start wondering, okay, so it's all great. People are saying, they're launching a project in Amman, they're launching a project here and there, and at some point people looked around, and I remember they're looking at me like, are you going to take it? I'm like, I don't know. So, but jokes aside, it obviously needs to balance, right? So you need to have demand for the supply. And it's not that there is no demand, but there is no demand at the terms that they're ready to supply it. It boils down to economics. Again, if you look at hydrogen, given the example I'm using hydrogen, for steel to make sense now, hydrogen needs to be definitely below €2 per kilogram. As a reference, the current price in Europe is more like 6 or 7. So if you use hydrogen at the price, it will result in a steel cost of at least 40, if not 70, 80% higher than it is. So at this price, of course, there is no off-takers, and some of those off-takers, some of those producers, they're really trying to get the funds, and all the financial institutions telling them, make sure you have an off-take, and then they will provide this fund. Fair enough, right? And that's the reason they're all struggling. But I think this is where we can set some precedents, and for some of our portfolio companies, I can see now they're getting to the stage where we can comfortably consider having an off-take agreement that will give them, more, increase their ability to get this funding from the financial institutions, because obviously, then they can see, okay, once we provide this funding, they'll get to the scale, they'll start producing, so they'll off-take, okay, kind of, now you're connecting the dots, and now this, it becomes much more bankable than otherwise. So I think off-take makes it just much more bankable. because there is a demand, and of course, demand at the terms. Terms are still to be agreed. I think this is the key challenge. It's really the economics. Most of the cases, most of those technologies, for logical reasons, are still not at the case that you can really defend and you can say, I'm comfortably ready to pay what you're going to be producing.
And we're doing a set of case studies on offtake arrangements and advance purchase commitments. But for this moment, you're the offtake, which is to say, you now get to demand questions, or so let's start in the front row, and we'll kind of go back that way to start. Actually, no, why don't we do this? We'll give your name, ask a question, and then we'll collect two or so, and then we'll kind of put together. So, please.
Hi, Victoria Marquez. I'm working in impact investing, and we spoke a bit already about different risk tolerances of these investors, but also in the venture business when it comes to those different time horizons and expectations on returns. Do you simply expect, okay, these businesses will take a longer time to mature before they show returns, or how do you kind of manage those different expectations on time returns between the private and public investors?
Is that one question? Another related one that's right behind you?
Okay. Hi, Rodrigo Garcia. We do climate insurance, and I think the absent discussion here has been on climate adaptation. So just wanted to get your feelings on that space.
Okay, so anybody want to start with those two? Time horizons and then climate.
So I think I'll start briefly. We have this new vertical, we call it deep tech or advanced technologies, and basically the defense in front of the board was the difference with just normal advanced tech or whatever is this, what is this new category? And one of the biggest differentiation was, speaking of your question, that was time horizon, the potential upside. Obviously, right? We were comparing that to the internet or to vaccines, and this new type of steel or cement production that are challenging 100 or 200 ways of doing so. So in terms of time, we absolutely expect longer in this case, and not pressing companies to do any faster turnarounds in terms of capital. And capital raise, we also understand it's quite complex. You won't be able to assemble the round, this quickly as any, digital commerce companies within a couple months. It actually takes for some DFIs almost a year to process a transaction. So everything is getting expanded here. So.
Yeah, and I would think that also we have different products for different time horizons. So we have funds that are more focused on earlier stage companies. So it kind of depends on the what you're investing in. So for us, because we're in climate infrastructure, ours is a 12-year closed-end. It's a pretty common structure for a closed-end vehicle. So you're looking at investors who have interest in that profile. So I think it's kind of different in the product classes.
Anything about adaptation?
Maybe just before we talk about from the industry perspective, obviously it's a very long horizon. Again, to give you perspective, the capital cost to set up 1 ton operation, 1 million ton operation, depending on different technologies, between $1 to $2 billion dollars per million ton. So kind of gives you the perspective of how much is required. In terms of capital intensity, but also time to set it all up. And given some of those technologies, like we're talking about Boston, we are now they're looking at the cell size this room or even less than that. And in order to set up and produce some sort of average size facility, you need a couple of football fields at least. So it's also this physical part of it, so just very, very time consuming. So it's definitely much more than time horizon.
And how about financing adaptation? When I showed the numbers, it was this tiny little sliver for adaptation and the rest of it was mitigation. Any thoughts about how climate finance might start to fund adaptation? I know BlackRock's done some work on this recently.
Yeah, it's really challenging, right? Because our investors are, as you can imagine, infrastructure investors are looking at contracted cash flows, right? We haven't really seen that many adaptation opportunities where you have that type of revenue, to be blunt about it. So I think it's difficult that's why it's so difficult to finance. I do think that there is opportunity in the blended space, though, for that, because at the end of the day, we can't mitigate our way out of this. I mean, we need to have climate adaptation investments, right? So I do think that there could be opportunities with blended finance where you have mission-oriented investors that are willing to, to provide some protection there on the revenue stream. But it's a long slog, I think.
More questions? Put over here. Yes.
My name is Jing Zhao. I come from both China and the UK. So, as I know, US has enhanced central planning for industrial policies. So, will you think this is an indication for lower political risks for private sectors to invest? Because in China, we have a central planning for a long time, and government even, play the role as a general partner in VC. So I think our situation in some parts in China, in US is similar.
Yeah, I'm trying to, so you're saying that there's a difference between how China does industrial policy in the US. And the question is, what?
I mean, US has more central planning for investments in climate change. So will this be a lower political risks for a private sector to invest? I mean, yeah, that doesn't make sense.
The US has more.
Central planning for industrial policies.
No,
I
I
think
don't
it
feel
depends
like.
on what happens to no.
I don't feel like the IRA is helpful, obviously, but even that, we don't know.
In Silicon Valley, there's some technological garden. They have some special policies.
Not familiar with this.
Yeah.
We'll
Thank you.
Yeah.
ponder that one. Yes.
Hi, my name is Madalena Pruna. I work for IFC in financing electric vehicle fleets in emerging markets. But I had a question on electric vehicles and sort of the technology is there. And in emerging markets, there are several business models across the board sort of popping up. And so you mentioned the infrastructure investors as being one class of investor fairly risk adverse, but also quite familiar to project finance, and right? So how do you see that intersection? Do you see more uptake of that? I'm just curious.
I think there's a lot of excitement with e-mobility. We're actually one of the BlackRock, our pure play platform, one of the largest investors in e-mobility. And in the emerging market space, we've seen a number of really attractive and interesting opportunities, whether it's electric buses, whether it's battery swapping, but charging infrastructure, obviously. So no, we actually see a lot of excitement even with that investor class in e-mobility.
And in the front row, Uday knows a lot about this, so wave your hand and talk to him about it.
Oh, you should answer the question. We're off takers.
You want to say a word about buses?
Buses? Yeah, sure. It's what's called a cold call. We need a huge amount of capital off balance sheet for cities, states, corporations. Long-term investors want yield. If we do this blending right that we're talking about, we can make that happen. We need good contracts, we need good regulations, we need developers to get involved, but these are tremendous new asset classes that are emerging. My country, India, has a 50,000 bus program that's emerging. It's not always easy. We had to structure a payment security mechanism for delayed payment, but you kind of have to build the entire ecosystem around the blending. You and I have talked about that in terms of structural de-risking, and then the thing works. And battery swapping, of course, we're super excited about, but that I take off my foundation hat and put on my commercial hat with the largest battery swapping company in India. And it's been a lot of fun because we've lowered the cost of electric mobility well below diesel and petroleum without subsidy. And that's fun because now you're really taking the whole thing to a different level. Back to you.
Thank you. Your cold call experience of the day. Yes.
Yeah, hi, Bill Lees from Braemar Energy Ventures. My question, having a person who has both project background as well as venture capital, it's an oxymoron to try and bring the two together, truly. Okay. However, my question to you was, on first-of-a-kind projects, besides getting an agreement in place, a long-term agreement for products sold or for feedstock, what else, what other risks do you need to address that would make you more comfortable to take, this risk for blended financings? Because it's a big one. People are really slow to finance these things, and obviously you're at the cutting edge of trying to figure out how to do this, so I'm curious. What else besides long-term agreements?
Is that to?
It's to all three. Sorry.
Well, the number one thing is definitely, I mean, you could work on other ways to get comfortable without long-term contracts, right? So we have you see deals that are, I guess, in the parlance of power, merchant deals, for instance, right? So it's not just you have to have long-term offtake contracts in order for us to invest or be interested, but then you probably need some other way to like manage that if you don't have a long-term offtake.
And I think for steel, again, I'm thinking specifically around steel facilities. So if you have a first of a kind, say, Boston Metal, right, so direct electrolysis, I think it will boil down again to the economics and to ensure that, for instance, there is an energy contract in place, because it's going to be very energy intensive to make the whole case better. So I think some of those aspects around the energy supply and then, what's going to be the cost of the product. But again, first of a kind facility is going to be much more expensive than the traditional greenfield.
You can also do like sponsored guarantee, dependent on like whether or not it's like a wider platform. If there's other things, other diversity in that sponsor, you might be able to look at some of the other things.
And I would probably add a couple words from like our angle to even get to be interested in the technology. It should have potential in the markets where we can do project finance. And this is also investors' value preservation, because imagine if you can support company, going forward without spending the most expensive money on building infrastructure. This is actually making perfect sense. Like this is how we were with like one of our portfolio companies. That was almost the investment case for equity, that we will at least then be able to support the company going forward without diluting itself. So this is from our standpoint, that we're just trying to preserve, like the value of our investment into equity and see how it's going to grow.
And I think scalability is another aspect, right? It needs to be scalable.
So we have just a minute or two. Can I just take the last question? We are probably 1/6, 1/7 of the way towards the climate finance funds we need. So none of us in the room have a magic wand, but if there are one or two things that would fundamentally alter the scale, what would they be? We can get another 10%, 15, 50 maybe, but if you want 5x, 6x, which is the range that we're probably talking, what's it going to take to get that kind of scale? That was the assignment question.
I think it's just creative, sophisticated. I think you need to get to this financial engineering. Obviously, in absolute terms, Peter, you were showing the numbers we need to invest, and it's just you don't have this financial institution now that can address that in its pure form. So you need to be creative in how you layer it and bring it together. And I think we discussed a couple of specifics, but I think if we were to say how we can accelerate and start those projects and get them off the ground and get them to the FID stage, we need to get them to this bankability. And a lot of them require this, at least in our cases, a couple of $100 million to get them there. So we need to think about financial platform that would be able to take this risk and address this middle territory.
What's your solution? Financial engineering.
I just saw so many projects across different countries, and the flavor of each would be different. So it should be quite country-specific solutions, where also their own governments understand what's going on. So this is first thing, maybe going back to the question that's already kind of like settled differently. The government support and the mandate and basically even government orders of take. That's pretty important thing, and this is what we see sometimes through different taxation program or grants that been given, like into certain acceleration, innovation type of things. I saw a fantastic job that Morocco did, like they created this engineering and entrepreneurship accelerator, and then suddenly so many new type of companies tackling climate as well. And another thing, I would probably say that if we look at who are the capital providers, we kind of, sorry to say, missing banking sector quite a bit, because probably of the different, exactly, a completely different appetite for type of risk, but maybe when we have such a nice and elegant financial stack, maybe we could, invite this type of player, because more and more conferences or, like round tables we're having, they have an appetite for that. It's just, like the stakeholders at this point are yet hesitant, but how many companies are trying to get the risk even in the US, like to get money on top of, let's say, deal grant, like that we need to build that facility, where we get that money. And then again, we are falling back to investors, diluting founders, and that's obviously the question for further control, less attractive organizations like ours. So I would say just maybe to increase that capital stack players.
That's right.
So I would say, I have two wishes, but I think one would be better regulatory enabling environment. So it goes down to obviously making the projects themselves more investable, but also like a regulatory environment where, for instance, for insurance companies and pension funds that are a huge institutional investor, if they actually had better regulatory charges associated with blended finance, such that we're risk mitigating, right, with the blending. So if they actually had better regulatory charges, that took into account that their risk of loss is lessened from the blending, that would be immense, because then we would have all of these more investors going in. So that's one, that better regulatory enabling environment. But maybe the second one is going back to what I started with, more engineers. Like I said, so excited to see so many people in this room, because the more people are interested and learn this and want to do the structuring as hard as it can be, because we're doing it, we're like doing it now, and we're not, I guarantee you're not doing it the best way that can be done. But more people thinking about it, more people doing it, will build it faster, build it better, build it at scale. So those two things.
Great, well, thank you. And what they did was they actually filled out this. Because if you think about it, the first one, the engineering solution, that's the top one. We need more engineers. The blended finance, get more people to the table, get banks to the table, get insurance companies to the table, and who's going to get them to the table? Probably governments and regulation, perhaps. And then the final, return transformation. I think that one's a government too, because somehow you've got to change the fundamental economics. And very few organizations in the world can change the fundamental economics until scale comes. The scale effects come way, way down. So a lot of work to be done for those of you engineers. There's, engineers will save the world. For those of you who are kind of financiers, you will also save the world. And for all of us, I hope you enjoy a nice cocktail.